You are listening to Investing Matters, brought to you in association with London South East. This is the show that provides informative, educational and entertaining content from the world of investing. We do not give advice, so please do your own research.
Hello and welcome to this Investing Matters podcast. My name is Peter Higgins. You can find me on Twitter/X at Conkers3. Today I have the huge privilege of speaking with Asif Suria, an entrepreneur, investor with a focus on event-driven strategies, including merger arbitrage, spin-offs, legal insider trading, buybacks and SPACs. He is one of the earliest contributors to Seeking Alpha in 2005, and his work has been mentioned in Barron's, Dow Jones, BNN, Bloomberg, and many other publications around the world. He's also an active investor and has been for over 2 decades. And he's got a fantastic background in technology and has developed his own tools to inform his investing process. Now, what an introduction that is, Asif. Thank you ever so much for joining me, sir.
Thank you, Peter. That was a wonderful introduction. I don't think there's anything I could potentially add to that, unless you have questions about it.
Thank you ever so much. Now, additional to that, obviously, you've operated as an executive at a venture fund in San Francisco Bay Area. And basically, you've grown companies as well as an entrepreneur and merged companies. And you've been looking at this event-driven sort of side of investing for many, many years now. So on top of that, you've then delivered this, got it here in front of me, this fantastic book just released this year, which is, as everyone should be reading now, we're going to talk about this book later on, The Event-Driven Edge in Investing, 6 Special Situation Strategies to Outperform the Markets by Asif, we've got here. But I'm going to do some background stuff now. So you, ladies and gents around the world, get the essence of the individual that I'm speaking to today, his professionalism, his unique knowledge set, skill set, and why you should be buying his book. Okay, are you ready for this, Asif?
I think so, Peter, but we'll find out soon enough.
Brilliant. Thank you, sir. Okay. I want to start, if we may, please, by you sharing with our global audience a little bit about your educational background regarding engineering and computer science, please, sir.
Sure. So I started out my undergraduate education in civil engineering, and at that point in time, I also decided to, in parallel, study computer science. It was 1996, 1998. The internet was just beginning to boom, and I figured, it'll be helpful to have 2 different skill sets coming out of college. I moved to the beautiful state of Oregon. I went from a very hot part of India where we only had one season, which was hot, hotter, and hottest. And I moved to Oregon, which was this beautiful state on the western side of the United States, where it rains 9 months of the year. And I was just in heaven. I was like, I don't have to look at the sun ever again. Because all my life growing up, I couldn't quite understand why the Beatles kept singing, "Here Comes the Sun." That wasn't a very positive thing for me. But when I got to Oregon, I began to understand, what people in London probably felt when you have so much rain. It was just a brilliant place. I went there for graduate education. I studied computer science. Got done in 2000, right as the Y2K bug hit. For people who've been here on Earth for as long as I have, you can see all the gray hair. They might remember the Y2K bug and how badly people were worried that it would essentially bring everything to a stop. So I got started as a grad student fixing the Y2K bug for the University of Oregon and getting their systems back up and running. Looks like they enjoyed that so much, they liked the work so much that I ended up building an enterprise system for them, a software system that handled admissions, awarding of degrees, so on and so forth. We really enjoyed the process of building the software, so I decided to license the software from them and go and sell it to other universities, which was my first experience as an entrepreneur, and it didn't go very well. Just being able to write code and building software does not translate into building companies. And so around that time, I also got interested in 2001 in investing. The dot-com bubble had peaked and it had burst. And about a year in, I felt like things had fallen quite a bit and maybe I should start investing on the long side. I couldn't have been more mistaken. Stocks continued to go down for another 2 years after that. So it was a trial by fire, and I read everything I could about value investing and so on and so forth. So it was these parallel journeys as an entrepreneur and as somebody who started investing on his own. And I found that the experiential part of investing, where you are investing your own money and learning from your own mistakes, is very difficult to replicate. You can read a lot of books, including mine, but sometimes it's hard to internalize the lessons that you learn in the books. So it really has to be a combination of learning from others' experience in books, as well as going through the process yourself. That has been tremendously helpful. As an investor, yeah, Peter, you had a question?
No, please carry on. I'm enjoying this. Continue.
Yeah, so as an investor, I went through the journey that a lot of us do. We start out reading Benjamin Graham's book. We learn about Warren Buffett. We get shocked at just how expensive each share of Berkshire Hathaway trades at. This was before the B shares existed, and the first time I looked at it, I think it was trading at $116,000 a share, and I just couldn't get my head around it. So I started to learn about Warren Buffett, read the books of Peter Lynch. And just like with every value investor, you can first get excited about buying $1 worth of stock for 50 cents. And then you begin to realize it's trading at 50 cents for a reason. This is a value trap. It's not a value opportunity. So I went through that process and I figured, maybe there's a different way to approach this. And I've eventually settled on growth at a reasonable price. I figured you buy good companies at fair prices. That's been very difficult to do over the last few years. Everything is trading at an elevated price, but GARP has worked from time to time, and that was a brilliant strategy that I was using, that I was happy with. But then over time, I ended up being introduced to event-driven strategies. The first one being merger arbitrage, where you are buying the stock of a company after a merger has been announced and before it closes. I think one of the earliest merger up situations I participated in was Oracle, the database company, buying Sun Microsystems. And there was some speculation about the deal being held up in Europe. And you had the opportunity to make an 8% return in a few months. And that was exciting for me. And I did that and it worked. Usually in investing, when you get lucky early on, when you really have no clue what you're doing, it hooks you to the process or the strategy. And that's probably what happened to me. I probably did not understand the regulatory risk. I did not understand how the two companies probably worked well with each other or did not. So there were a lot of things to learn. And I went through the learning process over the following 14 years, if you will.
Brilliant. Now,
During that time,
we'll go back just a little bit. But
sure.
we've got a wide range of individuals listening to this, including fund managers and ultra high net worth individuals and institutions. But we've also got some new investors and traders that listen to this particular podcast. In layman's terms, can you please explain and convey to our audience what is event-driven investing, what it encompasses, and what I think you've almost started explaining it there. Plus, what attracted you to event-driven strategies and arbitrage, please, Asif.
Yeah, so event-driven investing, as the name says, is about a specific event. Usually it's a corporate action, so there has to be some kind of corporate action or maybe even an executive action that occurs that classifies it as an event-driven investing strategy. So it is also often referred to as special situations. So there are books that are written on both event-driven and special situations. Usually it refers to merger arbitrage, when two companies are merging and you have the option to pick up a few pennies before the deal closes. It also refers to spin-offs. So for example, McDonald's used to have Chipotle inside it and it spun it out as a separate company. Fiat Chrysler had Ferrari inside it and it decided to spin off Ferrari as a separate company. So spin-off is another special situation. Liquidations are other special situation where a company, essentially is going bankrupt and goes through the bankruptcy process and hopefully emerges on the other side stronger without as much debt as it used to have. So that is a special situation which I haven't covered in the book because the complexities of liquidations are very difficult for most retail investors to work with. But I did introduce things like legal insider transactions. So I'm glad you mentioned the word legal at the outset, because when I say insider transactions, people are like, oh, you get to know what's going to happen in the future illegally, hush, hush. But that's not the case.
No,
this is executives. Exactly. These are executives who are, buying their own stock on the open market and they file with our Security and Exchange Commission (SEC), or if you are in Canada, that exchange, that regulator, or in the UK, a different regulator. So legal insider transactions is something I introduced into the book that doesn't normally fall within the realm of event-driven strategies.
Brilliant. Now, I'm going to cover this briefly, and then we'll get to the launching of Inside Arbitrage. So you launched a quantitative firm called Signal Partners, and that was with venture capitalists. So this is the first bit I wanted to ask you, because there's very different stories I hear from various different people I speak to about their engagement with, their relationship with, how things worked out with working with venture capitalists. What was your experience of that with regards to launching Signal Partners? Asif.
Yeah, so this was interesting. I'd been writing about insider transactions, the legal kind, every night. So I would review the transactions that were filed with the SEC. I would look at them every night and I would write about them. And every week we would publish something called the Insider Weekends, where we would essentially aggregate all the insider buys and sells. And we would look to see in aggregate where insiders selling more or buying more, and what was happening with those trends. And then we would highlight 5 purchases and 5 sales each week that looked interesting. So for about 2 years while I was writing this, there was a venture capitalist out of Seattle, Paul Goodrich, who was reading my content, and he invited me up to Seattle, said, I'm interested in insider transactions, looks like you are as well. Maybe we should consider doing something about this. He was a managing director at Madrona, which is the premier venture capital firm in Seattle. Just to be clear, Signal Partners wasn't an investment through Madrona. It was a bunch of managing directors at the firm that decided to invest individually into us. So Paul and I started working together, and he said, would you be interested in maybe collecting a decade or more of data and then doing some deep analysis, quantitative analysis, to see maybe there's a way to beat the market and outperform the market using insider transactions? So we did that for about 6 years. We did deep research in this strategy. We overlaid a fundamental database that we acquired from FactSet. And then we even did machine learning before it became quite popular as AI these days. So we ran things through machine learning models, where my technology background did help on that front. And we found a group of 8 strategies that we liked quite a bit, and ended up raising a small pool of capital to test the strategies in the real world, if you will. And so we ended up building an algorithmic system end to end that was completely automated. It would look at the insider transactions, it would pick the companies, and then it would trade for us. And when it came time to sell them, it would also sell them for us. So we built this beautiful piece of software that did it all for us. And we did that for about 3 years. The first year was brilliant. I generated returns of about 24%, outperformed our benchmark index. And then we got very excited and overlaid fundamental factors on that strategy exactly at the time when we shouldn't have been doing that. Value was not in favor. Everybody was moving to growth and momentum. And for the next 2 years, once we overlaid that, performance, while positive, was not as great as the market. As I mentioned, it's been hard to beat the market the last few years. So at that point, we decided to conclude that little experiment. We learned a lot from it. We really enjoyed working with each other. And we brought Signal Partner to an end at that point.
No, I think it's brilliant what you said about the learning of that. The strategy works, and then the market actually changed from underneath the strategy rather than the strategy not working. And it's always about looking at what's going on a macro level sometimes, irrespective of how good the machine and the automation works. Because I love the fact you said, as a psychological level, you allowed the machine to do the work for you and take out the emotional tendencies to either buy too late or sell too early or whatever. So that's brilliant. So we're in 2022 now, and you then decide to focus purely on Inside Arbitrage. Can you give our global audience just a quick overview of Inside Arbitrage, its website, the methodology, who your clients are, and a few other nuances about the way you've decided to put it together? Because I think it's unique that you've got so many different strategies, which obviously led to the writing the book, which we're going to get onto next as well, all overlaid as well.
Yeah, so one of the things I was doing, Peter, was I was building tools for myself. So when I got interested in merger arbitrage, I decided to build a tool where I could track all active mergers that were announced, and that would automatically calculate the spreads for me. Essentially the difference between where I could buy it and if the deal closed, how much profit I could make from it. One of the things with merger arbitrage is, a deal might close in 3 months and I might make 4% on that position. But if I can repeat that another 3 times in a year, then I can make 16% that year without taking compounding into account. And so what happened was I ended up building a tool for that. And I had a website where I was focused mostly on merger arbitrage. And then I had another website where I was focused mostly on insider transactions, like the Insider Weekends article I would write every weekend. And at some point I figured I was just going to combine both of them and create Inside Arbitrage, which is why the name is Inside Arbitrage. One website was Insider Transactions, the other was Arbitrage. And once I got started with those two, I got comfortable working with those strategies for several years. I decided to add the other event-driven strategies. So spin-offs, stock buybacks, SPACs, and management transitions, which was completely fascinating to me, but I realized very few people actually pay attention to what's happening with the management. So we decided to create a website which had a set of tools, but also where we would write content about it, either every week or every month. So it's a combination of, using the tools to gather the data, to display the data, and then try to draw insights from the data and write about them.
Excellent. And at this stage, you've been writing, I've been a contributor with Seeking Alpha since 2005. So 17 years of writing, mainly as a topic regarding insider transactions and merger arbitrage. So you were well known, and you'd established yourself as somebody who knew exactly what they were talking about. And I dare say you had quite a lot of people looking at the success of what had happened before, thinking, I need to buy that newsletter. I need to be on that website.
Yeah, so most of our subscribers on Inside Arbitrage are professional investors. There are also retail investors who either have a large amount of capital that they manage for themselves, or they have worked at investment banks in the past and are familiar with these strategies. They might have worked in a merger arbitrage department at a large investment bank. They might have been bond salesmen, so they understand the income side of one of these strategies. And so they probably were doing a lot of this by hand. They were trying to figure out all the news related to a deal, trying to figure out which active deals are out there. And essentially, Inside Arbitrage made it easier for them to just have all that information in one place. And on top of that, they get to read me pontificating about these deals every week, whether they like it or not, whether I'm making sense or not. So they get that as a either added benefit or maybe it's a negative. But anyways, that's how we have set it up. And a lot of these funds are multi-billion-dollar international hedge funds. And then there are funds that are just starting out and are exploring the strategy as an addition to their regular process. Maybe they are value investors or growth investors, and they are curious about a spin-off situation they heard about, or about a merger situation because Warren Buffett every once in a while participates in merger arbitrage.
Fantastic. Now we're going to get on to the book in a minute, but I want to talk about this journey that you had, please, Asif. So prior to talking about the research, can you please share with us what inspired you to write this brilliant book, The Event-Driven Edge in Investing, please, and the 6 special situation strategies that outperform the market? And I want you to touch on the roles of authors, Vitaly Katzenelson and Tobias Carlyle as well, please, and what that role they had in your journey to writing this book.
Yeah, so the book came about kind of almost serendipitously. 2 years ago in Silicon Valley, I met a friend for lunch. He had been working for Google for several years and decided to retire at a young age. And he said, hey, I'm going to hit a few things off my bucket list, and I'm going to go to Berkshire Hathaway's annual meeting in Omaha. And this was something that I'd always wanted to do as well. So I said, hey, maybe I'll tag along. I just quit my role as an executive at a mental health company that I was working at, and I'm going to focus on Inside Arbitrage full time. So maybe this is a great time for me to join you for this. And he said, yeah, don't even apply for your tickets. I already have some extra tickets. Just come along. And I went with him, and it was just amazing. I'm so glad I did. It was the last year Charlie Munger was at the annual meeting, and I got to hear them both speak. And it's just so inspiring to watch not just their track record as investors, but how they think about the human condition and how we should all be treating each other. Last year, charity was a big part of what Warren Buffett focused on. He talks about wills and so on and so forth. So you get this, somebody with decades of knowledge being so open and willing to share it with you. Even if you know some of those things, it's good to hear it again, because as humans we tend to forget the important stuff way too frequently. So went there for that, and then I started thinking a little bit about what else was on my bucket list, and writing a book had been one of those things. I think for over 8 years I was making some notes in a Word document that I thought one day might become a book, and it actually isn't the event-driven edge in investing. I think there's another book in that document, but I decided to see if I could write a book. Instead of self-publishing, I wanted to go through a traditional publisher just to learn the process and understand how that would feel. And so I reached out to 2 or 3 authors that I've been virtual friends with, that I've been in touch with before, and 2 of them, Tobias and Vitali, both introduced me to Harriman House within an hour of each other. And so it's hard to get traditional publishers to pay attention to you, but I think having 2 of the authors write to them within such a short span helped. And so they got on a Zoom call with me and they asked me why I wanted to write the book. And I mentioned that, the last big book in this area was Joel Greenblatt's You Can Be a Stock Market Genius 25 years ago. And things had changed quite a bit since he wrote that book. And I had new case studies that might be of interest to people. And they seemed to buy into that idea. And it just happened, and I ended up writing the book.
Fantastic. I love that journey. And I love the fact that you were taking notes and doing notes all of that time, essentially writing, articles from 2005 onwards. So that's fantastic that you took that journey. And also the fact that you had that realization from meeting with your friend that actually there's some things that I want to get done as well. And I need to pursue those before before time passes by. So thank you for that. So I want to talk now, if we may, about the research that you've done on event-driven strategies over the past 19 years that led to the book and its 12 case studies. And then we're going to go on to talk about them by section: merger arbitrage, legal insider transactions, so on and so on and so forth. We're going to go through the book essentially in the next half an hour.
Sure. Yeah, so some people ask me how long it took to write the book. I was holed up in a WeWork for about 3 months to avoid distractions, and I wrote it there. And WeWork was, kind enough to do an event at their location yesterday for the book. So that was very nice. It was the same place that I wrote the book. But, the real answer is it didn't take 3 months. It actually took 19 years, because that's how long I'd been focused on some of these things and I'd been writing. And so I was able to take some of those case studies from articles I had written in the past and expand on them. And I'm so glad I did that, because writing crystallizes your process, and writing articles definitely does that. But writing a book takes it to a whole different level. Now you have hopefully a much larger audience, and you really need to be able to back up your claims. And so it made me read multiple academic papers to see if they either confirmed or refuted what I thought of. And so the process was actually very helpful for me. I was able to expand on each of these strategies, and I was able to learn a few things myself as I wrote the book.
Fantastic, fantastic. Now we're going to go straight into the book now, Asif, and we're going to talk firstly about the chapter you've written on merger arbitrage. And my first question to you regarding merger arbitrage: can you share with us some of the nuances, the risk and profitable opportunities of using this strategy, and how can an investor or trader enhance their chances of success with such a strategy, please?
Sure. So merger arbitrage is also called risk arbitrage. More frequently these days it's only referred to as merger arbitrage, but back in the day it was known as risk arbitrage, because you are taking on the risk that a merger might not close. So essentially all investing is probabilistic. It's even more so when it comes to merger arbitrage. You're trying to ascertain the probability of a deal closing. And usually I find it useful to think of it in terms of examples. So Microsoft was acquiring Activision Blizzard. This was right after the video game company Activision Blizzard had run into issues with sexual harassment and so on and so forth. The stock had dropped a lot, and Microsoft stepped in at a very opportune time to try to buy this company. They made a deal for about $95 a share. The stock was trading at little below 65 when they announced the deal. And immediately the stock moved up close to about $80 a share. But it didn't go all the way to 95. And the reason for it not going all the way to 95 is the various risks associated with the deal. There could be a financing risk in case the person acquiring the company or the company acquiring the target company doesn't have the money to close the deal. And we do see that from time to time. In the case of Microsoft, that was not an issue. But the bigger issue with the Microsoft deal was regulators might not want a concentration of business or power in one company. And they might look at the deal and say, hey, this is going to hurt the competition. Activision Blizzard titles like Call of Duty might no longer be on PlayStation, and Sony might not like that. Electronic Arts might find it difficult to compete with Microsoft owning Activision Blizzard and so on and so forth. So there's a significant regulatory risk where a regulator might step in and either ask for more information, which would delay the process and the time it would take to complete the deal, or completely stop the deal, if you will. So the risk and risk arbitrage can come from financing issues. It can come from a regulator stepping in to block the deal. It could even come from shareholders voting down the deal, sometimes to their own detriment. I've seen shareholders vote down a deal and then the company almost go bankrupt after that. People are not rational all the time, and that extends to investors and shareholders voting on deals. There are other times a company might be trying to take out a company at such a low price that shareholders, rightfully so, don't believe they should allow that to happen. And in that case, they're making a rational decision to block the deal. So there are many reasons deals might not work out. But as we looked at our database of deals, and I looked at over 12 years of data, 95% of all deals ended up closing. The regulatory environment right now is a little difficult. And everybody talks about the big deals with large spreads where you can make a lot of profit, but are also very risky. But behind the scenes, some of the smaller deals and some of the deals that don't have very large spreads continue to close. So even in a year like 2020, when you had the COVID problem and all of the associated issues with the pandemic, 90% of deals ended up closing in that year as well. So I think when people look at merger arbitrage, they think about the headline deals that either succeed or they fail, and they draw the conclusions. But when you look at the data, it's actually quite fascinating. That said, the last 2 years, regulators, especially in the US, have been taking a very close look at deals, and deals that we wouldn't have expected to be blocked are getting blocked. The companies are fighting back. When the FTC sues them, they're actually going to court and trying to win. And in most cases, if they do fight the lawsuit, they're actually winning and the deals are closing. So merger arbitrage, it's important to remember it's also called risk arbitrage. And I view it as an alternative to an income strategy. So at a point where interest rates are very low and you get very little money or return on your bond investments, I used to prefer merger arbitrage. I was able to squeeze out a better return using merger arbitrage than investing in fixed income.
Brilliant. Thank you for that. And also in your book, you touched on the Elon Musk Twitter saga as well, which I think everyone should remind themselves of, because there was a spread there of 66% from the original price, and then it executed at that price anyway after much time and deliberation, and potential lawsuits as well. So absolutely fantastic. I love something you've written. Within your book, what I love is your tone of phrase, Asif, and I love the fact that you're actually trying to have not a joke, but you want to have some camaraderie, a sense of camaraderie with the reader, because you write as you speak with me now, and you're always smiling. And there's a bit here which I love, the turn of phrase, where if you can share this with our global audience, when you write about averages and the law of the 6 foot tall person in a river. Can you expand on what that means, please?
Yeah, so I'm 6 foot tall myself, and I've swum in rivers before, and I'm acutely aware that if I didn't know how to swim, as soon as I hit a patch that's 6.5 feet, I'm going to drown. So that little anecdote, I've heard it from somebody else, but it resonated with me because of my personal experience swimming. So, the law of averages is you could assume that, maybe you're 6 foot tall and you're swimming in a 5 foot deep river and you might be okay, but, you will hit patches that are, 8 feet deep, and you'll hit patches that are just 3 feet. And it really, you have to understand that averages, don't capture the entirety of what is actually going on underneath the surface. And that's the reason in statistics you look at, not just the mean, you look at median and other things.
Absolutely brilliant. Thank you very much. And the current one or situation that I looked at recently on this was US Steel with Nippon Steel. As right now the trade unions are involved, even President Biden's involved, and it doesn't look like that deal's going to go through. So Cliff might come back and get it at a bargain. Who knows? So that's a possibility. Right. Thank you for that, sir. I want to touch now on what we are using the proper term, legal insider transactions. I want to talk now about the buying side of it. I want to use the quote that you've used in the book regarding Peter Lynch and what he stated here. Insiders might sell their shares for any number of reasons, but they buy them for only one. They think the price will rise. My first question regarding that is it that simple? Or have over the past 2 decades, have you noticed certain nuances that have alerted you to outperforming signals?
It isn't that simple. Maybe back in the day it was. But what's happened is, if you've read George Soros's book, and he talks about reflexivity, where an action leads to the market reacting to the action, and then that changes the relationship. I think the same thing has happened with insider transactions, where the insiders realized that investors were paying attention to what they were doing. They realized Peter Lynch was going out there and saying insiders are buying only for one reason: the stock is going to go up. And they said, oh, now I can signal the market. I can make a few small purchases and people are going to pay attention. And sure enough, that did start to happen. I was at an investor conference in Dallas last year, and I was talking to this company CEO. It was a chocolate manufacturing company, and I liked their chocolate, so I decided to attend their session and talk to the CEO. And I said, hey, I noticed your insider transactions, and I could see from the smile on his face that he was glad that I did. So that kind of reiterated the fact that a lot of the insiders are often buying to signal the market. But there are other insiders that are buying because they think the stock is cheap and the market has gotten it wrong. So there are definitely nuances to it, and I've come up with a few strategies that I find useful. At the very basic level, it is, you look at what the chief financial officer, the CFO, or the chief accounting officer are buying, because they are in the weeds there with the financials, and they understand how much money is left in the company for it to survive or for it to thrive. Or maybe the general counsel, they are the legal folks. They're going to be very careful about how they purchase stocks. They're very intelligent. But again, that misses the fact that often these folks are excellent executives, really good operators, but they're not investors. They might not know how to value the company. Sure, they might know a lot about their own company, but they might not know what's going on in the broader industry quite as well as an analyst and an investment bank or an investor might, because they're looking at the broader big picture. They might not understand what's happening at the country level. Not all of them, but not every one of them is running a DCF model to understand what their stock should be valued at. So there might be a little bit of a disconnect between what they might know about the company and what investors might know in terms of the big picture and how to value the company. So I decided that, I was going to look at these independent directors. So they are not part of the management team, who've been on the board for a very long period of time. So maybe as much as 10 years, who have an investing background. And I found that every time I run into one of those, and it's not very often, those purchases have been brilliant. You absolutely have to do your own work. I came across Lululemon a couple of weeks ago, and I visited 6 different stores, both Lululemon stores as well as competitor stores, in addition to looking at the valuation. So you really have to do your own work on these situations, but it's an excellent idea generation machine. And then take that idea generation machine and overlay some of these patterns that you notice, and it can be absolutely brilliant. And that's what I ended up with. I like independent directors who've been on the board for a long time with an investing background.
Brilliant. I love the fact you've touched on that nuance about the independent directors as well, because that's that's an area that most people won't look at. And like you say, they've got a broader sort of outlook regarding the whole market or the whole sector. And also they're not getting paid the same sort of level of remuneration. So they're investing their own hard cash ordinarily into that company. So thank you for that. So on the flip side of that, then, what should investors be looking at regarding asserting information from the selling, whether it be in clusters or a large sale from insiders regarding the company? What should they be looking for regarding that? Is it a red flag ordinarily?
No, it isn't. For the most part, insiders are awarded a lot of their compensation through stock options or restricted stock units, which vest periodically, and they do keep selling. If they're selling because it's an options related sale or a RSU related sale, they have to indicate it as such in the Form 4 filing. And so you can look at the filing, you can read the footnotes, and you'll realize this is not a direct sale. They often make mistakes way too frequently. So what is an options related sale looks like a regular sale. And so you really have to read the filings to understand what's going on. But they sell for a variety of reasons. And, they might want to buy a car, an expensive car. They might want to buy a house. They might want to send a kid through college. So there are a variety of reasons they end up selling. So I don't find the selling to be a significant signal. But every once in a while, if you were to see a cluster of insiders all selling, even as the stock is dropping, so you have momentum on the downside, that could be a negative signal. The other thing I find useful is I look at aggregate insider selling and aggregate insider buying, and I calculate the sell buy ratio every week. And we have the data up on the website for anybody who accesses the book or reads the book. And you can see patterns in that where, during times like COVID in March 2020, selling dried up quite a bit and buying almost doubled or tripled compared to selling, which is something we had never seen in the 10 years before that. So I find it very interesting as an aggregate signal where you look at both the selling and buying to see what insiders as a group are doing. Once you exclude certain transactions, such as Jeff Bezos deciding to sell $5 billion worth of Amazon stock in the next few weeks.
Indeed. Now, I'm conscious of the story that you've got regarding the two briefcase Bruce story regarding insiders within the chapter regarding the insider transactions chapter. Do you want to share that with us regarding what the nuances were regarding that? Because it sounds like it's something that we should be sharing with others.
Yeah, so like most investors, you end up with the too hard bucket, investments or a sector that you can't understand and you're better off staying out of. For me, that is biotech. I have no background in biotech. I think you need multiple PhDs even to begin to understand one small sliver of that industry. So I leave that in the too hard bucket. But every time I have invested in a biotech company, because I've been dragged into it for various reasons, it's worked out very well. So, you have to force me to do it. And when I do it, it works. And one of the reasons, or one of these examples where it worked out was a company called Vertex Pharmaceuticals. They make a group of drugs to treat cystic fibrosis. And they are here in the San Francisco Bay Area, a little bit further than where I live, but they're in the same area. And I happened to write about it one weekend. I didn't know much about the company. I didn't know much about Bruce Sachs, but I happened to write about it. And I heard back from one of my subscribers who had actually worked with Bruce Sachs back in the 90s. And he said, oh, this is two briefcase Bruce that's buying. And if he's buying, then I'm going to buy. And I didn't quite understand what he meant. So I said, hey, can you explain what do you mean by two briefcase Bruce and why do you want to buy if he's buying? Remember, this is biotech, right? So most of us have no clue what's going on with these companies. So he mentioned that back when he was working with two briefcase Bruce, Bruce would, on the weekends when you didn't have laptops that you could take home and continue working, would fill two briefcases worth of work in his, take work with him in two full briefcases, complete that over the weekend and come back on a Monday morning. And he was just so hardworking that people realized that, he worked through the weekends and they started calling him two briefcase Bruce. So they knew that he was brilliant and they knew that he was hardworking, which is an excellent combination just in itself. And add to that, he'd been on Vertex's board for over 10 years as an independent director and had never bought stock on the open market. So he bought stock of Vertex, and a few weeks later, I noticed that the CEO bought stock as well. And just looking at the financials, this was not a early stage preclinical or clinical stage biotech. They were actually making money on their drugs. So looking at the cash flow statement, the income statement, the balance sheet, the investment made sense on its own merits, not just looking at the pipeline of what was coming in the future, which is the part I can't figure out with biotechs. So looking at two briefcase Bruce buy, the CEO buy, and the fact that the financials look good, I decided to buy as well. And sure enough, the stock has gone up more than 100% from there. And that subscribe was spot on about two briefcase Bruce.
Fantastic. These little nuggets, these are gems. Asif, thank you very much. Oh my days, that's really, really good. Okay, so we're going to talk about stock buybacks now. They're often a sign that the company thinks their shares are undervalued. What are the other main reasons that buybacks are launched, do you think? And what have you found in your research as well to cover that off?
So there are some companies that are called the cannibals, where they're constantly doing buybacks and they do very well with these buybacks. Apple is an excellent example of this. Carl Icahn, way back when, convinced Steve Jobs and Tim Cook. I think it was Steve Jobs was probably still around at that point to do buybacks, and it did work for Apple. It has worked for other companies like NVR, which is a home builder and has been constantly buying back its own stock. But what you notice is it works in some cases, but often, company executives are tempted to buy back stock at exactly the wrong time. Many industries are cyclical. When you look at the energy industry, when you look at shipping, these are very cyclical industries. And there are times when things are going great and you're getting a lot of cash, and that cash is burning a hole in their pockets and they don't know what to do with it. Maybe there aren't great opportunities for acquisitions. Maybe they can't invest in getting additional new ships because it takes a long time for a ship to be delivered after you place the order. Maybe they can't drill for more oil, right? So they often end up doing buybacks at the top of a cycle when they are flush with cash, which is exactly when they should be preserving that cash, because eventually the cycle turns, the supply balance imbalance hits, and people are scrambling to get hold of capital. And that could be a time when, if you have capital on your balance sheet, you could go and buy weak competitors that might not survive, or you could increase production or whatever it might be at the down part of the cycle. And so what I find with stock buybacks is, I think often companies do it at the wrong part of the cycle, and they don't have an excellent understanding of the macro picture as analysts do. The same thing that we talked about with insider transactions applies at buybacks. So one of the things I do at Insider Arbitrage is I look for companies that are both doing buybacks as well as the insiders are buying. So we call this the double dipper, where both sides of the company are buying back their own stock. And we use that as an idea generation screen to do some further research to understand, are these cyclical companies, has the management team in the past shown the ability to do capital allocation and have seen a good return on their capital allocation strategies.
Fantastic. You stole my thunder there, because I was going to ask you about the double dippers, but thank you for covering that off brilliantly. Conscious of the time, so I'm going to move straight on and just ask you one question regarding the special purpose acquisition company side of things, the SPACs, which have come, and some may say they've already gone already. But the question I was going to ask you was essentially, what were the lessons learned by traders, investors, venture caps, hedge funds, and ultra high net worth individuals regarding what people are now calling the poster child of SPACs, WeWork?
Yeah, so WeWork was a fascinating story. There's a whole Apple TV show about it called We Crashed that I highly recommend. It's very entertaining and you learn a lot about what happened. They tried to go public, and everybody looked at their S1 filing with the SEC and they said, this makes absolutely no sense. Not only is this company not profitable, they were trying to use a new phrase called community adjusted EBITDA. EBITDA in itself is a difficult thing for investors to get their minds around, because you're excluding all kinds of expenses that should actually remain in there. And then you have the adjusted EBITDA, where management gets to take out even more things to make it look like the company's profitable. And here they had this thing called community adjusted EBITDA. So soon enough, investors said, this doesn't make sense. The IPO got scrapped. SoftBank did not get a chance to exit their WeWork investment. by having the public buy shares. The public just wasn't willing to do that. So this was a time when the SPAC bubble was blowing up, and there were investors who raised a bunch of capital, hundreds of millions of dollars, where they raised the capital first and then went looking for an operating company to merge into and use the capital for. And this is something that had worked for decades before that. I came across this in a different way in the early 2000s in Oregon. That was my first exposure to it. And now they're called SPACs. They've been called other things in the past. And so what happened with WeWork is they decided to go public through the SPAC, and it was a public company. I happened to meet a couple of entrepreneurs in the Salesforce Tower in San Francisco, and I happened to go to a WeWork there. And it was very beautiful. It was set up really well, and I got interested in the company. A friend mentioned that it looked really nice. He's used locations all over the world. But once I looked at the balance sheet, it was very clear. There was no way this company could make money. They had so much debt and so much in terms of interest payments that they were going to continue to make losses. It did not matter if occupancy rates went up to 100%. It did not matter if they increased the price, the membership fee. There was no way for this company to make money. So SPACs became an interesting area for hedge funds to find companies that should not have gone public. Some of these companies were just science projects. Some of these companies were just a presentation. They had no business going public. And they would look at these companies, and after they went public, they would use it as an opportunity to short the stock and wait for it to drop. So there's a whole other way to make money on SPACs on the long side. But in the interest of time, Peter, I would recommend people check out that section in the book because it's a little bit complicated, but it's also fascinating at the same time.
Brilliant, thank you. And we'll move straight on to the spin-off sections that you covered as well. You wrote a beautiful quote inside the book, of one of many. Spin-offs are the part of the circle of life for companies. Please, can you expand on what that means? It's beautifully written as well.
Thanks. So with spin-offs, it's another corporate action. You have companies that grow initially through organic growth. They're expanding into new markets, revenues growing up. And then over a period of time, they reach a certain stage where they start making acquisitions. And more often than not, the synergies they expect from acquisitions don't quite work out. They get sold on a prospect that doesn't play out as expected. And so these companies end up with a bunch of disparate businesses that shouldn't have been together in the first place. But hope springs eternal, and they ended up buying these companies. And eventually a new management team comes along and they look at the business and say, this makes no sense. We are selling toothpaste and we are selling semiconductors within the same company. And we need to, split this company. And that could be one of the reasons a spin-off happens, which is what happened with GE. Larry Culp has done an excellent job of spinning off various divisions to then be left with GE, which became the aerospace company, high growth, high margin business. So you got rid of all the lower growth, low margin businesses through spin-offs. But there might also be another reason. There might be a gem inside a large corporate bureaucracy that once unfettered and free might grow at a very rapid pace with an incentivized management team. So you saw that happen with Chipotle when it was spun out of McDonald's. You saw that happen with Ferrari when it was spun out of Fiat. So there are two reasons. One is you want to simplify the corporate structure and get lean and profitable again. And the other reason might be you want to incentivize a management team to grow a division where it might grow much faster on its own than being inside this large bureaucracy, if you will.
Fantastic. Very well covered there. Thank you very much. Now, briefly, I want to just ask you one question on management changes and why you consider that, when it's significant, i.e. the founder or the CEO, as a potential red flag that investors should maybe take an opportunity to arbitrage.
Yeah, I mean, we've seen this with countries like Singapore, where an excellent president or prime minister can make a significant difference. You guys in the UK had an election recently. You've had multiple changes of prime ministers. You've seen this in Brazil, where Lula is back, and before that it was Dilma Rousseff, and you see these changes, and you can see what a significant impact a great leader can have on a country. By the same extension, a great CEO can really make a big difference to a business. Warren Buffett's quote notwithstanding, where he said that if a good management team meets a bad business, it's the reputation of the business that survives. But if a good management team meets at least a fair business or a good business, that can be very transformative. And I think that is a big source of future returns, but it's also very difficult to understand. So the way I think about management changes is for large companies like GE or Intel, which had a new CEO come in 3 or 4 years ago, it can take several years for the transformation to take place. It'll probably be at least 2 years before you start seeing the signs. But for smaller companies, you probably start seeing the signs after 2 quarters. Sure, they're going to be able to increase profitability in the near term by cutting down costs. But at the end of the day, can they generate additional revenue? Can sales start to grow? That is the signal I'm looking for. And I kind of correlated with the size of the company. So a small market cap company, it might take a few quarters, but a large company, it might take a few years.
Fantastic. Now, Ali, I'm conscious of the time, so I'm going to quickly ask you about your personal investing strategies and some of the examples of your long-term investments, because I'm conscious that with regards to what you've learnt, you've also put into practice regarding your own wealth, and this should enable you to actually practice what you preach regarding in the book as well. So it's conscious that other people should learn from the way that you invest as well as what you've written.
Absolutely. The reason I built Inside Arbitrage was to build tools for myself to invest. The reason you use these strategies is for my own personal portfolio. And the reason I do 6 strategies is each of them has their own season. Merger arbitrage at this point is proving to be difficult because of regulatory risks. Spin-offs have made a comeback. They weren't doing very well for a couple of years ago. And so I like having multiple strategies as idea generation machines and understanding that at different market cycles, different strategies are going to work well. In the late stage of a bull market, I don't want to be a value investor because I might run into more value traps than I would run into value opportunities. Similarly, I can supplement my value or GARP strategies with event-driven strategies in case I don't want to invest in bonds in a low interest rate environment. So essentially just increasing my toolbox and idea generation, and that's what these strategies give me.
Brilliant, brilliant. Now, this question I wanted to ask you because I was going to ask you this earlier, but I've left it until the end. And I think you've covered it in part, but I want you to expand on it if you can. Your key lessons and learnings from your time working in finance, capital markets as an entrepreneur, running your own venture fund, and the capital markets, etc., in the industry, and also an executive of the fund. What have been your main learnings, Asif? So the wins, the failures, and the growth that you've had over the past 20 years. That's most important.
Yeah, markets are constantly evolving. You have to be a learning machine, and it's such a privilege to work in a dynamic industry like this, where everything is changing constantly. Keeps you on your toes. It keeps your mind sharp. You're constantly learning about new companies, new industries. And what I find completely fascinating, and it took me a long time to get to this, was the failures are actually very helpful. You could learn something or you could read something in a book, and it's very hard to internalize those things. But if you have an investment that doesn't work out and you objectively look at it and say, did I make a mistake here? Or did the company change on me? Or did the industry change on me? That pain of the failure will make you learn and have that lesson stay with you for a long time. And you could take that lesson and invest in a competitor down the road. You could invest in the same industry a few years from now, and it will more than pay for that failure. So I've found that, way back when in the 2010s, I was an energy tourist where I didn't understand the industry well enough. And I took my failures and I learned from them. I spent months and years trying to understand what went wrong. And that paid off very well over the last several years once the energy market turned and I understood why it was turning. So don't let the failures discourage you. If things don't work out, use that as a learning opportunity and stay the course with investing.
Fantastic. I love that. Thank you ever so much, Ali. Now, I'm conscious that this book has only been out for a couple of months now, and I've been recommending it to everybody already. And I'm conscious that you haven't told me yet that you're going to come over to the UK to promote it personally, and I'm hoping you are. But I want to say to everybody that's listened to this podcast, please go out and find Asif's website, which is Event Arbitrage, Insider Arbitrage, sorry. And please buy this book because of the different strategies. And I love the fact of, I hadn't really found that nuance, but you've just encapsulated it there about the seasonality of the strategies as well, which I don't think people pick up on regarding the differences and the availability. As you say, that's going through a lull. I've now got an opportunity over this side. Spin-offs are happening because people are getting overvalued, or they've gone, they've taken a misstep. And now there's an opportunity here for insider transactions, legal insider transactions. So thank you ever so much, Asif, for coming onto this podcast. You've been absolutely amazing. And I'm looking forward to hearing more about this book going forward. I've got my copy here. I'm going to buy some other copies for some other people that I love and close to me that I want to outperform the markets as well. And please, can you just give one shout out to the name of your website and where people can find you as well, please, Asif, before you go?
Yeah, so Inside Arbitrage is the name of the website. You can search for me, Asif Suria. I'm on Twitter, on LinkedIn. So you could be able to look for me by name, or you could look for Inside Arbitrage or the Event-Driven Edge in Investing. Peter, I really appreciate you doing this. I really enjoyed this conversation. I could see the depth of your experience come through and the kind of questions you were asking. So this was a lot of fun. Thank you for doing this.
Thank you ever so much, sir. And I'm looking forward to speaking to you again soon. I will be getting this out for you in the next couple of weeks, and we'll keep the conversation going. And if there's any opportunities of you coming to England, please let me know, and I'd love to support you in your continued growth. And you're educating everybody for the last 20 years. So thank you ever so much for sharing that with our community as well. Take care. Asif Suria. God bless you, sir.
Have a wonderful evening, Peter. Take care.
Thank you.
Bye.
Thank you for taking the time to listen to Investing Matters. Be sure to check out the London South East website for free tools and info to research your next investment. You can also join in the conversation on our social media channels. And don't forget to subscribe to our YouTube channel for more content, including our CEO interviews. Catch you next time.